Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today I've got Patrick Karim with us. We're going to talk probably commodities in general, but we might focus on oil today. He had some pretty awesome charts that I saw on Twitter. So, thank you for coming on, Patrick. Appreciate you being here.
Andy, man, you bring so much value to everybody in the community, man. We should talk more often there. I keep reading all the comments. You have no trolls on your YouTube. I don't know how you do it. Everybody's nice. Everybody's thankful. So yeah, I'm thankful also there.
Do you have a lot of trolls on your YouTube channel in the comment section?
Well, because silver hasn't moved in a while, people are starting to get angry at me. I don't know why.
yeah, I could see. It's coming though. You just have to be patient. Yeah. I think what I've seen kind of on the back half is that's when the precious metals really start to take off, is when it infiltrates. All this inflation infiltrates all the numbers, and then everybody starts jumping in. So looking at oil, I saw you posted this on Twitter. What are we looking at here, and what is it?
Look, I had just done the gold chart, but right now when I chart gold and I see something, I'm going to chart silver and oil. I'm going to add oil to pretty much everything. It's a big element, because the oil chart, essentially, people look at the CRB index or whatever, but oil is everything. It's the inflation chart. I could probably overlay the inflation rate. Like, it's everything. It's like we were talking about before there on not your energy theory, but like everything's energy driven. And so I think this is like a uber critical chart for everything. And I think I could probably overlay silver. If oil's not doing good, I don't think silver's still going to have some difficulty. But okay, let's come back to this chart. Guys, this is a quarterly 3-month candle chart. So reduce a lot of noise. The data starts in 76, but like way before, but I just started more in the modern era, log scale. So that's also very important to note. And at the bottom here, I have the stock. But this is important, guys. Whenever you look at a chart, look at the indicators, the settings, and it's set at 84. So it's 84 period. So essentially this is 84 times 3. It's 3 months. It's 7 years times 3. This is the 21-year stock indicator cycle for oil. So it's price action is going sideways. The stock is going more and more bearish. Clips the bottom. But look, you have 1, 2, 3. That's an official trend line break. And in 99, okay, I put the line 99 here because I had some price action bullish, but it could have been maybe in 2000 when the stock breaks out. That's huge momentum that just broke out of this huge long consolidation. Price action also on the way out. So even if you have a couple of years after the breakout, you have a back test, it doesn't matter. It's still bullish. Higher lows. Here's the low. Higher lows. People think, oil's going back down to zero. But what happened after that? It went up 450% from 99 in 9 years. From here, 9 years. From here, it went up even more in like 7 years, all the way up here. All right, let's fast forward to today. 2008 peak in oil. 1, 2, right here. Another test here. Third test. Same setup, guys. The stock RSI, the stock reset. 1, 2, 3. Valid trend line in TA. Refusing to do lower lows on the stock. This is a wedge. I could have drawn here a wedge, a tightening wedge. And these bullish wedges, when they break to the upside, the target is always the beginning. See, it reached the target before. It broke out. So we have a price action here, breakout. I don't know. I could even draw another trend line right here. So it broke out in 2021 quarter Q2. Price action keeps climbing up. So if we close Q1 of 2022 up here, now we're above a horizontal breakout line. We're definitely above this long-term breakout line. The stock has broken out. And when we've had that close above here, it didn't come back until it's reached its overbought, until it went like in a crazy melt up Nova mode, right? And if I add 9 years to this breakout here, where we had that single, it brings me close towards the end of the decade, 2020, 2030, 2029, whenever this thing decides going to slow down. Look, it did 450%. It's a logarithmic move. I don't see why I shouldn't be able to add it. So if we have this type of move over, and guys like, $430 oil. Oh no, it's impossible. Man, this is going to be 430 like in 8 years, guys. Like, Jesus, just look behind. 8 years ago, it was in the teens or wherever it was here before it broke out in 2000. So they're adding zeros. Don't be odd. It's not $430 today. This is like inflation just going up and up and up. Could happen faster or slower. I don't know. But that's pretty much the technical analysis target I have for oil. I did other charts where the target was lower, but aligning these critical quarterly defined breakouts, these are huge momentums that aren't easily overridden like on the smaller time frames on the daily, monthly. And that's my rant for oil, man. It looks pretty bullish. And if you think you're late, I think on the quarterly chart, it looks like it could explode and then retrace. Probably going to retest this breakout line eventually someday, maybe the horizontal breakout line, maybe in 2024 or something. But right now, it just broke out of the gates.
Do you think the last bull market in 99 to 2008, could that be like the first leg and this could be a third leg if you were to look at it from like Elliott wave? Or, I mean, I'm just asking. I don't know if they're correlated at all, because I know a lot of people say that the gold market started in 2000 and now we're moving higher. So it's one continuous type of kind of move.
Well, I know that on this chart, this is the okay, some crazy price action there from way back there, 1862. Were they using oil back then, or they were on horses? But yeah, either case, this is how I see it. And a lot of people forget, because these commodity cycles before 1970, they were ranging. I'll show you some older charts where everything was ranging like between a range. And then in the 70s, it just exploded out. We had a new plateau. And right now, I think what we're living is it's a new plateau. So let me bring these lines here. I'm just going to try to outline these new plateaus. So right here in 1970, it's a paradigm shift. This is game over. We're never coming back here. We added permanent zero to the price. Now the 70s explode, then range for, I don't know, 30, 40 years. Now we exploded in 2000. We're creating this new plateau. And I think right now what we're heading into is actually it's going to be a new plateau eventually, where the low watermark is going to be. Once we break above 130, we could have an explosion upwards to these high targets. Let me get my squiggly tool. Look, I don't know how it's going to happen. Maybe here, 2024. But once we go up to my final target, let's say 2027 to my 430, I think something like this is going to happen. Like, we're going to a higher plateau, guys. We're never going to see this again once we retest that line and it never comes back. So this is pretty much a likely scenario. Explode, I don't know where, 140, wherever it's going to decide to stop. It's going to stop at 110. Retest 2024, somewhere, maybe retest that breakout line, maybe that horizontal breakout line, a spike down on the smart time frames. Well, once we close above, it's just a higher plateau. Look, I'll put the soy futures. They're all doing this, the commodities, all of them.
Yep.
Look at that. Yeah, here's a soy. So pre-60s, it was probably ranging here below this plateau. 70s create a new plateau, oscillating, everything's fine. And 2004 tried to create a new plateau. In 2007, it created a new plateau. We're there. And look at soy. It's heading for what I call, like, I don't know, we could call these generations. And it's just something like that's going to happen there for whatever. Okay, maybe not there. Soy, lumber, coffee, sugar. They're
all doing it, which means it's inflation driven. That the money coming into the system is greater than what all these commodities can actually. I call it hold. They can't hold their value. They're going to have to go up to hold their value with the money coming in. So,
oh, geez.
Because we're seeing it in corn's going up, wheat's going up, soybeans going up, cocoa is about to explode to the upside. They all look ridiculous.
Yeah, and I put this crazy chart. Look, let's look at the. I don't know if you saw this one in my thread. I redrew the inflation chart based on the 1990s shadow stats, or like how he does it.
Mm-hmm.
Hold on, I'm just gonna Where is?
Yeah, one thing that people
Where's
forget is they calculate the inflation rate completely different today than they did in the 1980s. So when people compare a 1980 CPI number to a CPI number today, they're not comparing the same numbers. So that's one thing I wanted to talk about.
Yeah, John Williams shadow stats. I should definitely sign up to get the real data. But here you see, okay, this is a 1990 based. So he calculated what the inflation would look like if it'd be based on the 1990s like type of settings, and we'd be about at 12% here. And in 2008 peak or 7, we're clipping maybe 9%. And if you calculate it with the 1980s, it's even worse. We're at 15%, 15, 16% here. And in 2007 or 8 peak, we're just under 15, maybe 14. So I took this one, the 1990s, and I just overlaid here. I tried to make it fit there, but it was probably tighter here. Here was my peak in about 9% that he had in 2007. And then 12% what we have here. And look, this is inflation rate since 1915. And look at these peaks: 1 touch, 2 touch, 3 touch, valid trend line. And we actually we broke out above it. And if we do it in the 1980s, we're already hitting these previous highs here. So what could be happening right here? Maybe it's going to hit, come and retest, slow down. Everybody thinks inflation's gone. And then after that, it's going to go upwards. But this is I don't know, man. This is historic there. We're out of a descending trend line, and we broke out above. This is in line with your oil chart, like with a whole bunch of other charts there.
Yeah, it also lines up with all the food price commodity type charts too, because they go all the way back to like the 70s. I don't have the data before that, and then they're like breaking out of everything. Now, what does this actually mean? Like, if we were to actually try to wrap our head around what this is telling us that we've been in a 100-year disinflationary period.
Yeah.
We've been contained within this chart pattern, or I call it the psychological containment of whatever the pattern has on people. We've been in this containment. Now it's all breaking. That containment is breaking. What does that exactly mean? And I'm not trying to put you on the spot here. I'm just trying to think for myself. Like, does this mean that we're going to get like a massive inflationary period? Does this mean that we are going to go into a hyperinflation? Does this, like, I'm just trying to wrap my head around it just by looking at this chart, because this implication of a breakout is massive, and it means so much more than just looking at the chart and saying, hey, look, we've broken out here. It's like, no, this is paradigm shifting, right?
Check this out. Yeah, it's what was my ticker? Economics. This, well, economics, inflation year over year. Is that it? Okay, here it is. Okay, I'll just do, I brought this one just so I could have I could draw some lines. So here how it looks like based on just whatever the regular value. But let's say we do break out here, we're probably going to hit here and come and retest here, maybe 2024. Maybe that's the other like deflation where commodities have a hard time. And these lines I'm drawing, guys, are not random. They're okay. Let's stop here. So here, as a chart trader, you want to evaluate roadmaps. You want to see where you could probably halt. So usually you want to go test previous highs. And after that, you could probably want to retest where you broke out of. These are probably the levels that we could be bouncing around, something like that. But what you're seeing here is higher lows. It's a new uptrend. So you broke out of that thing, and until you close below until you close back below this rising trend line, wherever it's going to be, right? Because we're going to find out as soon as we come back down, wherever it turns back up, that we're going to have 2 points, and then on the third time we're going to have a valid trend line, and on the fourth, if it breaks, then we know the cycle's over. This is a type of scenario where we could be a new cycle that we had from the 50s, and we just go up and down, up and down. But instead of starting from the 1%, we're going to be starting from wherever wherever we're going to be. And yeah, I don't know, man, Andy, like we're going to have to see at each level where it hits, where it comes back down. But if you see the US dollar inflation adjusted divided by PPI for producer price index, or
yeah,
look,
I'm just
it's
trying
not
to
looking good.
I'm trying to think like what is driving it? Is it the amount of debt in the system that they have to inflate away? Is it the real estate starts with the amount of loans coming into the system? Is it the commodities and the underinvestment in commodities where it's just going to raise the price of everything higher with the population? I'm just trying to think of what, because if we can figure out what's driving humans to interact with each other to create these charts, then that would become our leading indicator. So we could see that.
Yeah.
So I'm just, I don't know. I'm just trying to think out loud.
Like one of my working theories there is I always try to bring it back to a family, like a nucleus. Like I've known, like when I was in physics class when I was younger, or in high school, they were showing us, like, let's say when you're reading about, like, let's say the nucleus and then the rings outside, and I thought it looked like an orange, you know, like a peel, and inside there's, and I always thought that everything was any type of ecosystems, it would resemble the same no matter what you took. So let's say I see some human driven, let's say big picture stuff, I would say, okay, how would I deal with my family? So let's say the government's me, a dad, and I have kids. And if I have, like, let's say some power over my kids, I would probably want to maximize that as much as I can until they grow up and they move out of the house, right? Like my tricks, and I would try to dilute my tricks, keep reusing my tricks, the same tricks over and over until they don't work. Well, the government right here in this fiat based, I just think, like we saw in the Romans or whatever, like these money historians, they sit. I think a government, no matter how, since they control the printing press, every time there's a spike and there's appreciation in their currency, it gives them just that extra power to reuse that same tool to pay off their debt, to depreciate, to win elections. And maybe that's the most, it's them driving this, and commodities are just reflecting the misuse of capital, of this depreciation through fiat currencies just being constantly, like, exponentially, like what's the half-life of this? Like every 5 years it loses like 50% or something, until one day they can't do it anymore, until my kids move out of my house, that I can't reuse my you know, like my techniques with my kids. The government eventually won't be able to do it, or whoever's managing the fiat currency. But I don't know, man. This is like, what's the chicken, what's the egg, right? Who are they doing this because human greed? They just want to stay in power. They want to win their elections, right? Promise goodies to the kids, right? And until they can't promise anything anymore, like the kids just move out until everything implodes.
I think it's inherent in the design of the system, where there's not enough principal to pay back the interest, and they keep blowing up and creating money, which means you've got all this interest out there. So I think they have to increase the money supply exponentially for the system in order to survive, to pay the interest payments in the system. But what we're showing here in that chart that you were with the inflation, and even maybe perhaps this chart too, I mean, maybe this is signaling that the market thinks that energy is going to get more scarce. So that would impact the price of everything. If you measure everything through prices, then the price of everything would go up if your number one commodity, say oil, goes up substantially. And that we are hitting peak oil, and that energy is going to be expensive from here on out. You'd see patterns, like massive patterns that are declining and ready to turn up. Because back in the beginning, that's when oil was created, I think, or started getting pumped quite heavily in that inflation chart, was like the late 1800s, early 1900s. That's when we found oil back then. And then everything from the mechanization and the it's not necessarily the cost, but the ability to do work in society has always gone up. But at some point that's going to change and everything's going to reverse, I think, where oil becomes not just increasingly costly, but it's going to get harder to get. You're going to have less energy to do work in society, and the costs of everything will go up substantially. And we're kind of seeing the beginning of that. We're also seeing that the world capacity of oil is kind of like maxed out almost. Our inventories are getting drawn down, and we're going after lower quality oil grade, oil, we'll call it oil fields everywhere. With that lower grades means we have lower energy to use in society, like to do work. So that's what we were talking about earlier. I'm just wondering if that's playing out in the markets, and the markets are seeing that. I don't know.
Yeah, I don't know. It
It's
could be a
tough to
mix
say.
of that. Yeah, and everybody has a theory, right? So let's say uranium, how does that fit? It's going to replace oil. What about electric cars? Like, how much of that is aggregated in the actual final price of oil, right? It's like, how do you calculate that? Like the alternatives being used to replace oil, but then the supply of oil is like, Jesus, hell. That's why I love chart trading, because like, I know that I don't know, like these are like thousands of analysts across the planet, which are managing billions and trillions of dollars, putting their bets on where this thing is going. Who am I to try to figure out what all these guys who have inside information on the actual numbers are like? These, man, you think all these numbers about oil and everything, they must be crunched in a supercomputer somewhere, right? And somebody's actually figuring out the true, or they're trying to guess where this thing's going. But look, as long, guys, as long as oil is above an inclining, let's just try to keep it simple. Remove all my drawings. As long as it's above an inclining 3-year moving average, you just go long. That's it. Here's the 1 year uptrend, downtrend, sideways, explosion, uptrend. Look, it's just turning up, guys. So as long as it's staying above an inclining 1 year moving average, you gotta let that puppy ride.
What if you connected the tops of the oil price chart and did hit the 2 points? I know it's maybe not perhaps a valid trend line, but maybe we'll be, if you go back all the way to 1978 or 9, you hit the top of that one, and then you hit the top of 2008 and extend it forward, you'll probably get somewhere in like a $400 range where I think that may hit it and create that trend line, so to speak, possibility. And that's what I've done, is I've taken that and I said, okay, what if it were to go back and hit that trend line? That'll put you in a $400 and something range, $500 range, depending on where you hit it.
What timing did you have here?
I had the timing around 2028, 2030, somewhere in that range.
Why in the log?
Yeah, you are.
2026-7 right here. And that's if it overshoots. That's if we do the same move that we did from the bottom of 99. We'd overshoot all the way up here. That'd be insane.
So you did it from the bottom of 99, but you're going from the breakout of 2021 or 2.
True, you're right.
So what if you move it all the way down to the bottom there, and then put it kind of upward a little more? No, that's about right. Yeah, that's about right. We get real close on it. Yeah, I think it's somewhere like on that bottom, something like that, because that bottom was like a false bottom.
I know.
With the medical event.
Yeah, you gotta look like it for a pivot line. So let's say one touch, the most touches from either side, it's valid. See, even if we're under here. So this one could actually be here. See, one touch, back test. So this one's pretty reliable. I like this one here, this angle of ascent.
Yep.
2027, Andy.
Yep. That's where I get 2027, 2028.
For 360. And look, guys, that's fine. We could have, this is a target. If it doesn't reach it, and I always say, let's say we can't maintain that rate of ascent, and let's say we start curving down before, then that's it. We're going to be below a 1 year or 3 year move average. We close our positions and no harm done, So, but this would be probably a next plateau, next target. Like if it comes back, I think it's going to come back, but stay above 150, something like that. And then we'll see what happens. I agree. That makes, that's another way to see it.
Another thing that's real interesting that you showed in a couple of these different charts, if you tie them together, oil is very highly correlated with interest rates. the 10-year interest rate. So if oil goes up, the interest rate goes up. Now, if oil does something like this, that's going to put pressure on the interest rate to go up with it. And then you have that gigantic inflation diagram there too. That gigantic inflation diagram that was all the way back to whatever. If we're breaking to the upside, that's going to put tremendous pressure on interest rates to go up. So I don't know how they're going to keep interest rates low.
Well,
this is going to be interesting.
Look, if they don't, gold and silver are going to show the truth, because even if the interest rates kept going down here, oil going up, it is creating that real interest rates that drop, right? They go negative, right? Because if you do so that gold's still going to show you the truth that your purchasing power is going down, even if the rates are going down. So yeah, if they don't do it, I don't know. It's kind of an illusion, but they should go up though, these things are eventually.
Yeah, I think what's going to happen is it's going to hit a bottom and then it's going to break that downtrend line and move on up. But oil, the movements, the short-term movements of the 10-year and the oil price move very closely together. You can see it, except interest rates were just on a downward cycle trend. Now it's going to be an upward cycle trend, I think, eventually.
Right. I'm just wondering, sometimes I posted a chart a while back there, and I'm just wondering if this is more close to the 40s or 50s. We could see, hold on. I'm just going to show you this one. Where's my inflation rate? Here, is this one? I have a whole bunch of, hit that. Is that going to work? Okay, here. Check it out. Okay, here. Okay, this is the Fed. What I'm doing is I'm building the Fed fund rates, but from way back. You'll see why I'm doing this. Remove indicator. You're seeing a hack. You're seeing me hack. Where is it? Okay, hold on. XAG USD. Patrick, what are you doing? Move drawings. Okay, here's my Fed fund. Okay, perfect. And I'm going to hide silver. All right. Put that all on the same scale. Merge on the left. All right. And change the color. So here what I have is, put that black. Remove drawings. Okay. Here I have the overnight rate. Nobody ever sees this before. Like people say, here's a Fed fund rate. The data starts in 54, but it used to be called, I think, the overnight New York Fed fund rate or something. And that's how it looked like before 1945, right? Everybody's seen this first cycle, but what was the cycle before? And it was high here and the rates went down. Look at this period here. Sometimes we think, I have a theory, like I want this thing to go up right now, right? Well, I'm thinking that we could have another 10, can they stretch it another 10 years of, yes, insane negative real rates, but that they still maintain Fed fund rates rock bottom by doing yield control for another 10 years. And that would bring me to my, another theory I have, that it's in post 2030 that then they're able to let the Fed fund rates go up. So like this, bring them rock bottom, and then we just for 10 years, we go down, and then we start moving back up. And
that's a good possibility, because what they're doing is they're basically deleveraging the system. There's so much debt in the system that they have to get dollars back in the system, so they have to have a huge real negative rate to, I call it deleveraging the system. More paper dollars in existence to how much debt or interest payment is out there.
And that's maybe that they need to buy time, right? So I'm wondering if that's one of the we're going to see something like that there before we start going back up. It's going to get stretched. Jesus, my tool's crazy. It's just going to get stretched for years, and 2030, then it's when things really get crazy there later on. So look, the charts are telling me oil, the logic says they should raise the rates to fight this inflation. But if they don't, let's say they try to raise it a couple of percent and then it crashes back down. it's not going to stop oil and gold from going up. But before really the interest, that's just sad, because that just means that our purchasing power is going to go down the drains even more, man. The more they wait to bring up the rates, the more our purchasing power is gonna get demolished.
Yeah, it's gonna get hit on the dollar, or currencies, I should say, in general. Definitely.
Yeah, you'll be able to buy less. They're not protecting it. So rising rates encourage savings, encourage it's attracting value to people want to buy your US dollars or whatever dollars you have, and that's great.
It soaks up liquidity too.
Another...
When rates go up, people are more likely to put it in a savings bond or a treasury bond or something like that. If rates stay low and you have high inflation, it has a psychological impact where people are like, just, I'm just going to buy it. I'm going to buy this. And they're going to just continue to accelerate the velocity of money, which is inflationary.
I had some friends over yesterday, and people talking about the stores, like now they're starting, whenever they see something on the thing, that my girlfriend's buying a tofu, and she buys everything that she sees, because sometimes she lived it once that she wanted to buy the tofu. It wasn't on the shelves. Now, whenever there's some, she takes everything. You see how
Yep.
And the more people start doing that their favorite goods is not there for one time, the next time they see it, they're just going to buy twice as much, 3 times as much, because they say, Jesus, man, it's like the shelves, they're not always, some products are mismatches, some stuff's not there now. So yeah, there's that psychology aspect, I think, that's really starting to creep in there on people there.
We're seeing that too, just to let you know. There's certain items that are just gone, and I don't know, I do the same thing. I buy a little bit more just in case, and keep kind of an inventory at home just in case.
Well, look, if you have a freezer, stuff like that, you're fine. People in apartments, like, I wonder, they're trapped. Like, honestly, this inflation stuff, it's hurting the lower class, or whoever's like living day to day, has a small apartment, they can't stockpile, or they can't like have a little bit of a buffer. It's super sad, man. Like, I wish we could be able to help more of the folks there that are there's a divide getting created now. Either like you're becoming, I don't want to say the word elite, but it's like either you have enough assets, and with this inflation, you're levering up, so you're able to like outpace it, or like maintain your power. But if you're on the other side of the curve and you have nothing, you don't even have $1 in the stock market, or you don't have real estate. I have some friends looking for real estate right now, and it's super sad. It's super sad because they're super trapped, man. They have to go 500 kilometers up north. They don't want to go there. Like, Jesus.
You're talking about able to afford a house somewhere in a certain area or something?
Yeah, they
like
have
that?
to. Yeah, nobody could afford anything, even a house up north. The real estate agents right now, they say they're blowing off customers. You call them, say, okay, look, you come here and you have 10 minutes, and if you don't put an offer by the end of the day, it doesn't matter, because I have 10 that are going to buy the house. That's how crazy it is. You can't rent. My friend, houses in Quebec, if the building's less than 5 years old, there's no limit on how much the homeowner or could raise the rates. His rent, he had a small 4.5, I don't know how in the States, a small like 1,200 square feet apartment. His rent went from 1,500 to 1,800 in 1 year, 300 increase. I'm pretty sure next year he's going to be at 2,100. And these are payments, like before the housing went crazy, you could have bought a $400,000 house with $200 or $2,000 a month payment, right? It's like crazy. And it's like things are just spiraling out of control.
Well, that's what I was. So when we looked at some of these charts, and you've got these big breakouts, and you know how when something breaks out, it does it pretty powerful, right? You get a massive move higher, kind of like has a huge impulse move up. And I'm kind of looking at all this going like, is this the impulse move higher? Then we'll get a little bit of retest, and then we run again. The first wave, it's the first wave of a 3-wave move. The third wave is the big one that's coming, I think, behind it. But I mean, you've got this hump, and you described it. You got the hump, right? If you can kind of get some of your money above this hump of assets, it'll kind of like you've made it, you've protected yourself, and it doesn't matter what happens afterwards. Like you get a 30-year fixed rate mortgage, you get in a house, you sit in it and let the inflation eat it away. But if you don't get over that hump, you're subject to all the inflationary pressures and forces that are out there in terms of rent and everything else.
It's crazy. It's like I had to one of my friends, he brought the point that he was trying to convince my other friend who's a homeowner, trying to convince our third friend, like, you have to buy like a house. And he was trying to rationalize him. He said, you have to lock in that rent, because when you buy a house, at least you're locking in that rent. That rent is whatever, it's your mortgage payment. So at least you've protected yourself for the next 30 years. Look, it's not going to cost me more than my mortgage amount, 1,500, whatever it is. At least you protected yourself that you're going to have a fixed rent. But yeah, I don't know, man.
That's exactly what I did. Some years ago, I was looking and I saw the rent price and I was like, this inventory is declining and this rent is I think pretty low. And if I were to buy a house, I can lock it in at even a lower cost. And if something were to happen, I could refinance in the future and even lower it if we had a market crash. So I bought before 2020, a good ways before it. I locked it all in and then I refinanced even lower and I dropped my payments like $300-400 a month off my mortgage from refinancing. So now I'm paying very little compared to what I would be renting. I'm talking like I'm paying less than half of what I would be renting the current house I'm in.
And it wasn't always that way. I think like before all this, people used to have like spreadsheets and they'd figure out rent versus home ownership and the cost. And before all this stuff, unless like you really want to be a homeowner and be like a private owner or have a big lot, a lot of cases could have been made to rent, you know, an apartment, flexibility, all these advantages. But right now, it's not cost effective at all there to rent anything. And yeah, you have to find here you can't find anything to rent. Like if you go on whatever their Facebook page, try to it's people want to rent. There's nothing available anymore.
Yeah, one thing also is if I didn't own a house, I would be scared because it's really hard to get into one. I mean, it's like a battle. Even in where I live, there's a battle going on to get into homes. So people are literally just battling with how much money they've got. And they're like, I'll take it for, 30,000 over. And other people put clauses in there. I'll go $1,000 over the next bid up to 50,000 over. And then you'll get like an all cash offer that's like $100,000 over asking. And you're like, well, that guy got it. It's like, I don't know what you could do. Like psychologically, like mentally, I would be so beat trying to get something, at least in our city here, where people are just getting priced out.
So sad.
And I think it's going to continue to happen because we don't have enough homes. They don't exist, and people keep piling into the city from other states with much more money, and they can do all cash offers. They sell in California, they come here, and they say $700,000. I've got another 700 sitting next to it because I sold my other house for 1.4 million. And everyone who's here local is like, I can't compete with a $700,000 cash offer.
It's so weird what you're saying. It's like it's leaking. It's like, let's say the money printing, it's just a question of time until it leaks, right? It just leaks. So that big time Californian money, okay, Californians can't buy Californian houses anymore, but they're just going to move in. And just like the people in Quebec, they're going to move north. The money's leaking everywhere. Eventually, like until there's no more to leak, but visibly there's a lot still there, right?
Yeah. So how would you get ahead? The way that I would get ahead is I would get into undervalued assets that appreciate against real estate prices, right? So that's the way that you could get back into this system or beat the system, so to speak. So what kind of assets would you think may outperform real estate? I mean, obviously we just showed oil, and I think oil and the companies that produce oil would vastly outperform the price of real estate. What are some other assets that you think might outperform real estate?
Yeah, exactly. So this is where the racial charts they come in. I did this chart there. So any chart, let's say you want to beat real estate. So first you got to pop in the real estate chart. I'm going to pop it right here. And then you want to say, let's say, okay, well, let's start with gold. Is XAU USD. Wait, divide sign. There you go. Okay, let's do. Jesus, Patrick, man. Patrick. Okay. XAU USD. Okay, let's do that. And show that. Remove all indicators. Okay. Oh, cool. I have lines here. So right here, am I correct? Okay, this is the historical price charts for the index for, oh, wow, it's going back all the way. So these are the housing prices divided by gold. So when this ratio goes down, that means houses are cheap versus gold. When this index is up, that means houses are expensive versus gold. And when the I see 2011, yeah, that was houses cheap versus gold, right? That was the time to buy.
Yes, that's to convert your gold into
That
into a house.
So anywhere here, oh man, this ratio is kind of scary though. Jesus.
Yeah, you're seeing that, but what I think may happen is it's actually going to go down again.
It's gonna plummet down.
Yep, I think so.
So if it goes down,
and the reason I say, yeah, it's going to have a big
outperform
real estate.
Real estate, yeah, because that's a halfway flag also there. It's a
it's pointed upward, which means whenever something's pointed upward like this, the breakout's to the downside.
Yeah,
yep.
Here, yeah, it could be here. There's a pivot line. A few, even here. A few touches here. Spike, touch, broke out. Claim close to retest. Yeah, so something like that. So here you probably want to sell your gold and get back in real estate in 2028.
I think the bottom will be 2030, early 2030s. So the top will be 2027, 2028, and then we'll have a blowout recessionary crash caused by real estate. And then it's 5 years after the top is usually what it is. So if we peak at 2027, 2028, it'll be like 2030, early 2030s.
And you see it here, guys, for the rate of change. When so as that's a 7-year rate of change. So this is housing outperforming gold, but even, and you see the rate of change just plummeted. So housing is not able to outperform as fast gold as it used to, and it's right about to go negative. So once it goes negative, that means it's a bull mode for gold. So here it's in 2005, that's when gold really started outshining, or even 2007, it went even deeper. This was so that's an undervalued transition. So gold, probably other commodities are going to start outperforming. Doesn't mean that maybe real estate's not going to keep going up. It's just not going to go up as fast as
gold.
Even here, guys, look at here in the 70s, when the rate of change went negative, you were better to go in gold as gold was outperforming housing back then. And then when this ratio breaks back upwards, look at here, 1980s, get out of gold, buy real estate, and then you're good there. Interesting. So here, look, 2018 was really the peak of real estate versus gold, 2018. 2001 was the peak of real estate versus gold.
Yeah, I bought a little bit before that.
Right, in real estate, like, right here, right, 99?
Yeah, I bought before 2018. That's where I bought, but that's kind of like right peak, and then it turned, and I was like, "Ooh, this is going to get interesting." But I think that gold's going to do very well coming up. Oil, gold, all these other ones. I think real estate's going to do well too. The thing with real estate and why real estate's so good too is it's a leveraged bet. So you take a mortgage out against the home, and the entire home price goes up. So you can put a little money down and make lots of money in terms of a percentage gain on what you've put down. And that's why I like real estate. And you get to lock in your costs. So.
Yeah, well, yeah, exactly. Well, look, you can do that with gold and instrument, right? Buy futures, call options. But real estate, if you don't have a home, at least you could live in it, you know?
Right.
It's like, it's something real. And look at that. I just noticed that it looked like the US dollar chart, this ratio.
Yep. That's crazy.
So that means the US dollar is going to go down if this ratio is going to go down.
It's going to go down. Yes. The dollar is going to go down.
So we have to look. Yeah. We have to look down. Look. Yeah. It looks like, why? There's so many charts, Andy. Like I see them and I say, man, it looks like they're all financialized. So it comes back to the DXY I showed you at the beginning, right? The inflation adjusted DXY. It's, man, this is insane. I mean,
yeah, everything's tied to the value of whatever you price it in. And you just, now it's all a currency exchange thing. And if your currencies are all being debased at the same time, everyone's going to run to something like hard assets. That's why I think this is like the best setup that I've ever seen for commodities in general or precious metals. Because if every currency and all around the world, let's say, you know, Canada's having their housing boom, we're going to have a housing boom. We have all these housing booms. There's nowhere to run that's safe in a currency outside of maybe somebody like Japan or Singapore or some other currency like that that's been strong, where you go to those assets and invest in those assets in that currency because that currency is stronger and whatnot. So it's all getting financialized, everything. And all these assets move off of money flows based off of the dollar and interest rates. That's what I found.
Well, the more I dig, the more I see these charts, Andy, it gives, I like that word there that you put in my vocabulary. It's financialized. The commodity price, they're financialized. It's like, that's why they look like these financial ratio. It's like you said, it's almost maybe not about the actual supply and demand. That's probably secondary. It's just how much money is going somewhere, and that's driving whatever. It's hard stuff to wrap around, but we're learning. Like, I'm learning this stuff through the charts, talking to you, which you've definitely like thought about this a lot of times. And plus, you also look at charts, so you're not just there and like in the narrative fantasy land. You're actually trying to make sense out of this by looking at what's actually happening in the price action, right?
Yes. So I look at the charts first, and then I try to backtrack what maybe could explain it to find what's the leading indicators that are driving the herd. So that's how I look at things. So I don't just look at the chart and say this chart, this chart, this chart. I look at it and say, we've got this chart which ties with this chart. Why are they correlated? Like, what is the reasoning behind it? And is there something I can look at that can give me a leading indicator of why the herd is buying or selling this asset? And then what I noticed is you could see all the commodities are all linked up. So if they're all linked up, you cannot have it be a supply demand issue, because you can't have supply demand issues all at the same time. That's just impossible. So it's all financially driven. So then I looked at, well, what's causing all of this money to go into commodities all at the same time? And you just keep answering those questions as you go backwards. And what I found is the interest rates is the pivot point of everything. So it's inflation comes into the system. I found it to be tied to the housing starts, the credit expansion. And then the interest rate is what pivots all the money around. And then all of these charts align with that type of thought process or that type of analysis. So
when are we going to realize we're in a, like, are we in an echo bubble, me and you, or
in a like, what? An echo bubble?
Are we in a, like, are we in an echo bubble? Are we, or this is, for me, this is still like, this is, until the charts prove me otherwise, whatever we're saying right now, it seems like the most logical, highest probability situation that we're dealing with right now. Of course, we tweak as we see stuff and new evidence, but I don't know. This for me just makes so much more sense. And what's great is we're figuring this stuff out by ourselves. And I've often found that these conclusions, sometimes when you're not influenced too much by an external narrative, like sometimes I go look at other people's chart trading, but I try not to do it too much because I think it kind of hinders my progression in my own understanding. It's like of stuff, you know, it has to crystallize in your head that this piece matches with that piece. Okay, this makes sense. And talking with you once in a while, then you're able to refit a piece and tell me, Pat, oh no, look, Pat, that doesn't make sense. Or then, so yeah, it's like we're together, we're building blocks of all this. So I don't know if we answered your question, but definitely commodities, they're still the place to be. We saw on the oil chart, they all look alike, these charts, right? So if you find one, like especially silver, like it's it sucks, the chart, like it's really getting close to breaking down, man. That's probably one of the last arbitrage plays that's there, that a commodity that hasn't even tried to go up to its like all-time highs. But yeah, there's definitely others out there, right? Like uranium hasn't reached its all-time highs, right? Even the UX price.
Uranium is still one of the best. So yeah. when I look at things, Platinum. I say, what is a fact? Like, what is a fact? Ratios will tell you what's cheap and what's expensive. So uranium is still incredibly cheap as a ratio against gold. So that one I think is, and if you look at it from a narrative perspective, if we go to an emissionless type movement, or if we get energy shortages in oil, uranium is one of the most energy dense materials. So I think uranium is probably one of the best bets going forward from a really ultra long-term view because of its energy density, the properties of uranium. And it's probably one of the only bridge fuels that we can use between, say, like a peak in oil and whatever, like fusion out 30, 40 years from now, or however long it takes to get fusion going. That would be the bridge fuel, in my opinion, because it's electricity driven too. I mean, you can generate electricity with it. And if that's where we go, that's where we go. It fits all the criteria.
Yeah, those ratio charts, they're magical. So guys, don't focus too much on nominal prices because there's just adding zeros, right? So ratio charts, like we showed you the housing versus gold, just do ratio charts of anything and then see historically if they're high or low. And yeah, you could do some more in-depth technical analysis to make sure that it's not like it could go even lower, but that'll tell you definitely where you are in the cycle. Because if guys don't do ratio charts, Andy, they're kind of trapped because let's say somebody's buying US equities like right now, and they never looked at a 100-year chart of a ratio chart. They're dead man walking.
Yeah, they're going to run into a pretty rough period where the value doesn't go up against other assets. So all the other assets are getting more expensive against that asset. In my opinion, that's probably what will happen for the next at least 10 years. Yeah. At least that's the way I look at it.
Well, look, US equities, guys, I don't want let's say they go up 5% or 8% each year for the next years, but inflation's at 10 or 12. You're losing money, right? Your
purchasing power gains.
Purchasing power is going, like, look at the Dow charts from the 60s. They went sideways for 10, 20 years. 2001 to 2011, US equities went sideways, It's not out of the realm possibility that, and the racial charts are showing you that, and the producer price index and all that stuff that we've been covering for the past time. It's just showing the low risk, high reward options right now, or is anything that could hurt you. You drop a piece of metal, oh, it hurts your foot, okay, buy it, real stuff, that or maybe we're wrong, Andy. Maybe we're wrong.
So the ratios they're right. It's just it doesn't give you time. So we could be, I think we're right. Our timing could be off. So you're still buying good assets. You just have to wait longer for them to appreciate if we were wrong. So that's the way that I look at it. It'd be your time.
Guys, stop being in a hurry, man. They've been conditioned to make, crypto has conditioned people to make 1,000,000% gains in no time. So I'd rather be, with experience, I've learned that I'd rather be early but well positioned than just be all over the place, buying close to a top, because most of the people, they're going to buy within 10% of the top, and that's the nature of the beast, right? They get in, it goes up 10%, and then they think it's the beginning of the bull cycle. But if they look at the ratio chart, they would have just seen that they were just on the wrong side of, like, just the hill was about to turn down. But look, I'm still young, so but I understand people who are trapped, who have nothing, and they want to try to get rich fast. Unfortunately, the smaller time frame charts, they're just going to kill you. Like, unless you're super good day trader, and then you're highly specialized, and fine. But I just trust these big picture charts, and I'm just going to wait it out.
It is possible to make a lot of money very fast, depending on how the ratio moves. You can catch it and get lucky and have that really compressed. Like if you bought the bottom of 2020 in oil, I mean, that thing's rocketed higher in a lot of those companies. So it is possible. It's just, you don't want to try to focus on getting rich fast, because it's also very possible to get poor very fast too, or remain poor. Usually if you put a very short time frame on something, it puts a lot of pressure on yourself or on your portfolio, when you don't have to have that pressure, and you start making decisions that maybe aren't in the best interest for yourself, even because you want to make it so fast. So
I think
well,
a lot of people.
Mhm.
I think a lot of people could relate to that because we've all been through that. You want to make money fast, so your sell stops are shorter. You want bigger position size because you don't want to do 50% in 6 months. You do want 100, you lever up. But as soon as it starts going down, you'll sell at the wrong time. Even if you were right in your call, you won't even be able to stomach overnight that 30% drawdown because it's 30% multiplied times your leverage. You won't tell your wife, you have kids, you're afraid, and you'll sell. Even if you were right in your call, you won't be able to stomach the drawdown, So look, that's the nature of the beast of being over levered there.
Yeah, if you're gonna do something, don't use leverage. You can buy like warrants or something else that has more leverage inherent into it. But I wouldn't leverage up too much. I don't. I just buy stock usually. So that's all I've got. Patrick, do you have anything else that you'd like to share?
No, that's great, man. We talk about it for like 3 hours.
Yeah. Any way that we can reach you? It's Bad Charts One at Twitter. And
Bad Charts One, guys. Follow me there. Go follow Andy on Twitter also. You should have a lot more followers on Twitter. NorthstarBadCharts.com. You could find me there, guys. And it was fun, Andy, catching up with you. I hope everybody's going to watch every single minute. Tell me about those YouTube stats. I don't want to see a 30% drop after the first 5 minutes there. I want to make sure everybody watches everything.
Yeah, that's a tough one to get everybody to the end, but that's okay. If you made it, congratulations. If you made it to the end here, good job.
You win a gold coin, guys. You win the gold coin. Andy's going to send you a gold coin.
Oh, that's going to get expensive. All right. So if you made it, good job. Thanks for viewing, guys. We'll see you next time. This is Finding Value.